Good morning, everyone, and welcome. My name is Stephanie Ochoa. I am a national correspondent for Entravision based in Washington, D.C. And today we'll be discussing the latest findings from the 2025 DH Global Connectedness Tracker, which expands its analysis to capture early economic shifts following President Trump's return to office. The reports offers fresh insights into how policy, geopolitics, and business decisions are shaping globalization in real time. We'll explore how global flows are evolving, whether we are truly seeing a retreat from globalization or just a reconfiguration of it, and what the data tell us about the world's economic pulse. This is an educational program that is developed in partnership with DHL and NYU and Mr. Stephen A. Altman, Research Assistant Professor in the Department of Management and Organizations at the New York University Stern School of Business. The Association of Foreign Press Correspondents in the United States is solely responsible for the development and content of this program. Once that's said, please let's hear some words from Glenna Ivy Walker, Vice President of Communications and Sustainability at DHL.
Thank you, Stephanie. Just to give a quick background on the tracker. So the DHL Global Connectedness Tracker is a concise report as well as an interactive website that provides regular updates on globalization and global trade. It complements our larger global connectedness report that we've published regularly since 2011 in partnership with the New York University Stern School of Business. This special edition draws from over 25 public, private, and academic resources, and the tracker analyzes more than 20 million data points on international flows of trade, capital, information, and people. It includes also interactive online charts that will make it easier for you to explore the trends by region, geopolitical alignment, and also for individual countries. And we'll be sure to share the link to that interactive tool after the webinar, along with other relevant resources. And, just to say that in the face of rising geopolitical uncertainty and shifting trade patterns and policies, the DHL Global Connectedness Tracker continues to affirm the resilience and adaptability of global trade. We understand, that protectionism and trade barriers pose real challenges that cannot suppress the ingenuity of businesses who are determined to still connect and grow and explore new markets. And at DHL, as a true connector of trade and facilitator of trade, we recognize that agility and innovation and collaboration and know that it's more critical now than ever. And so we remain committed to helping our customers navigate the complexity, unlock these new opportunities, and most importantly, build resilient supply chains that thrive in an increasingly interconnected world. So looking forward to hearing the insights that Professor Altman will deliver today. And back to you, Stephanie.
Thank you, Glenna. Thank you again for this introduction. Glenna Ivy Walker, Vice President of Communications and Sustainability at DHL. And for this educational program, it's a privilege to be joined today by Professor Stephen A. Altman, Senior Research Scholar and Research Assistant Professor at NYU Stern School of Business and Director of the DHL Initiative on Globalization. Professor Altman leads one of the most comprehensive efforts in the world to measure and understand how nations stay connected or drift apart through trade, investment, information, and the movement of people. Professor Altman's research focuses on understanding the patterns of international flows of goods and services, capital, information, and people, how cross-country differences and distances shape those flows and their implications for business and public policy. He has managed the development of a variety of teaching and decision-making tools based on that research, and is a co-author of the DHL Global Connectedness Index, a detailed country-by-country examination of globalization. Professor Altman, thank you for being here. Thank you for taking the time, and welcome.
Thank you very much, and thank you to the organizers for the opportunity to bring our research to this audience. Really appreciate it. I'll share my screen here. Okay, with that, you should hopefully be able to see some slides. So again, thank you very much. I'm really delighted to present today our new special update to the DHL Global Connectedness Tracker. In response to this year's policy turbulence, we have updated and expanded our tracker, aiming to provide the most comprehensive, most timely available assessment of the state of globalization and global trade. The analysis in this edition of the tracker used over 20 million data points drawn from 25 sources. We focus on three key questions. First, how are policy shocks affecting the growth of international flows? Second, is geopolitical rivalry fracturing the world economy? And third, are international flows becoming more regional? I'll present highlights on each of those questions, and I'll also switch back and forth between slides and the tracker itself to give you a little bit of an introduction to how you can customize the analysis to look at the aspects of globalization and the parts of the world that are most that are of most interest to you. Let's start with the growth of global trade in goods. Here's how trade volumes were trending last year. And here I've added the 2025 year-to-date data on global trade volumes. Contrary to predictions that trade growth might go into reverse, or at least slow down in 2025, we saw a spurt of growth early in the year, bringing global trade volumes up to 6% above the previous year's level in March, and they've remained 4 to 6% above 2024 levels since then. When I looked back at the historical data, I found that actually the first half of 2025 had the fastest global trade volume growth of any half-year period since 2010, if we exclude the volatile COVID-19 pandemic period. So we actually started the year off with quite strong trade growth. One of the key drivers of that strong trade growth in early 2025 was a surge of imports into the United States as buyers rushed to bring goods in before tariff increases. But that surge, as you can see in the blue line on the slide, peaked in March, and yet global trade volumes, the purple line, remained above last year's level, even as U.S. import volumes dipped below the 2024 level in June. So U.S. imports was only one part of this story of trade growth. Another big contributor was the strength of China's exports, which have grown even faster than global trade. What's especially remarkable is how China achieved that exports growth despite a sharp decline in China's exports to the United States. Over the first 8 months of 2025, China's exports to the U.S. Declined by $51 billion, which was a 15% year-on-year decline. But China's exports to the ASEAN region in Southeast Asia grew by an even larger amount, $55 billion. That was a 15% increase. And China also increased its exports to Africa by $28 billion, a 25% increase, and also to the European Union by $26 billion, which was an 8% increase. So quite an expansion of China's exports during a period when U.S. tariffs on Chinese goods temporarily rose to above 100%. Now, one final point on trade growth in the first half of 2025. When we look at where the fastest trade growth was in value terms, it actually wasn't in China or the United States. That was actually in sub-Saharan Africa. I happen to be coming to you from Johannesburg today. We're launching this report in Africa to highlight some of the results from that region. Sub-Saharan Africa had the fastest trade growth in the first half of the year, followed by North America. The North America trend, of course, driven by that U.S. imports front-loading wave. At this point in the presentation, I'd like to give you a first little demonstration of how you can customize the charts so you can see the aspects that are most relevant to you. So now you should see on the screen the actual tracker itself. So it's a website you can go to easily. It's free online at dhl.com/globalconnectedness. You can see the key takeaways from the analysis. And here's the chart that I was just talking about. So I was showing which parts of the world had the fastest trade growth. You can, for example, if you're interested in drilling deeper into that, you can see which individual countries had the fastest growth. And you might notice here, unsurprisingly, smaller countries have volatile growth rates. You get some smaller countries having the fastest growth. One of the features we put in here was to be able to show also the absolute amounts of growth in different parts of the world. So you can see there, the largest amount of growth was in the US, followed by Hong Kong and Switzerland. And you can also narrow it by to particular parts of the world. So suppose you're writing a story about trade trends in Europe, you can easily get the ranking of which European countries had the fastest growth. So just a first introduction to how customizable every chart you see, you can delve further into it and you can see the details and you can customize it to see what's most relevant to you. So a first hint of the interactive version of the tracker. Here I'll go back to the slide. So far I've shown you how we had strong trade volume growth over the first half of the year, which parts of the world were driving that growth. Let's move then from the past to the future. So here what I'll do is I'll draw on the composite trade volume growth forecast that we pull together from 4 sources that we use in our DHL Trade Atlas report series. The red cross symbols that are on the slide now represent the trade growth forecast that we assembled back in January before the recent US tariff increases. So here you have a baseline of what trade growth we were expecting back in January. And these yellow bars represent the current forecast. Just 2 weeks ago, we went and updated all of this at the end of September. And so there you have a very up-to-date trade growth forecast. Unsurprisingly, tariff increases and uncertainty about future trade policies have prompted trade forecast downgrades. So the current forecast calls for slower growth, especially in 2026 than the forecast that we had back in January. Although the forecast does still call for positive growth in all those years, but it is slower. Looking at the forecast revisions by region, here I'm going across the 2025 to 2029 period. North America had the biggest downgrade. In North America, the forecast growth rate for trade over that period was cut almost in half. All other regions also had downgrades except South and Central America and the Middle East and North Africa, where there were small forecast upgrades. Most countries in those regions face relatively small US tariff increases, and the outlook for the Middle East benefits from increases in oil production and exports. Last point on the current forecast, we can also use that to provide some updated rankings on where we expect the fastest trade growth. Fastest growth is expected in the current forecast in South and Central Asia. India is a big part of that, followed by Sub-Saharan Africa, and then Middle East and North Africa. South and Central America, I didn't put a marker on it, but I think we have more participants joining this call from there. Follows quite close behind the MENA region, would rank number 4 on that chart. Going back to the global data, I'd like to make one final point about global trade growth, and it's a bit surprising. Here, I've added to the slide the actual growth observed over the past 2 decades, along with 2 horizontal lines. The line on the left shows the actual compound annual growth rate in global trade volumes over the past decade, and the one on the right shows the forecast growth annualized over the period through 2029. It's actually hard to see any difference between the two, and that is because they actually turn out to be the same. So we actually, when I calculated it, we have a 2.5% compound annual growth rate over the past decade, and the forecast calls for that same 2.5% growth rate through 2029. So even with tariff increases, trade is still expected to grow as fast through 2029 as it did over the past decade. So tariffs are expected to slow global trade growth, but not to stop or reverse it. Moving beyond trade growth, for a sense of whether globalization is advancing or reversing, we need to consider measures that capture the balance of international relative to domestic activity. In our report, we include an update of our DHL Global Connectedness Index, which tracks this across 14 types of trade, capital, information, and people flows. Here I'll just highlight 2 of those measures. The graph on the left here shows exports relative to global GDP to capture how much of all of the goods and services produced around the world are traded internationally. That was at a record high in 2022, and it remains very close to that record high level. And the chart on the right shows the share of mergers and acquisitions of M&A activity that crosses national borders. that also hasn't changed meaningfully in recent years. So these data and other measures with similar results in the tracker, I think, are quite important because they tell us that companies are not shifting their attention from foreign to domestic markets. To the contrary, what we see is that companies continue to invest in international markets at levels that are roughly in line with the historical trends in terms of balancing international versus domestic investment. Coming back then to summarize on the first question regarding growth of global flows. So global trade has proven highly resilient, growing even in the face of US tariff increases, and there's been no general shift from international to domestic business. So pretty positive message on the first topic. Moving on, the second question was whether geopolitical rivalry is leading to a fracturing or a fragmentation of the world economy. Let's start with an update on the increasingly fraught ties between the world's two largest economies, the United States and China, and then we'll zoom out and look at this in global perspective. Focusing first on trade, the shares of US exports and imports involving direct trade with China started to fall during President Trump's first term, and these declines have accelerated since President Trump returned to office. The imports trend is really quite dramatic. The share of US reported imports coming from China was at 22% in 2017. By 2024, it had fallen all the way to 13%, so down from 22 to 13. And then over the first 7 months of 2025, it fell further all the way to 9%. So big declines in the share of US imports that come directly from China. On the right of the slide, I've put the Chinese data, put the same data in China's perspective on those shifts. They're a bit smaller if you look at it from China's perspective, but the same message comes through. A big picture pattern of a weakening of ties between the world's two largest economies in terms of trade. Here's a chart in the tracker that takes the same topic and goes beyond trade, looks at multiple measures of capital flows, also of international research collaboration as an indicator of information flows. And the way this chart works, the little circles show you the share of US flows that were with China, the share of China flows that were with the US back in 2017, so the 2016. So the circles give you a baseline for how US-China ties were before the recent escalation of tensions. The bars give you the most recent levels from 2025, or if that's not available, 2024. What you can see is the bars in all cases don't get, almost all cases don't get as far as the circles, indicating a pattern of weakening ties across many areas in terms of relations between the US and China. To put numbers on it, on average across these types of activity, the share of US flows that are to or from China has fallen by 35%, and the share of China's flows that are with the US has fallen by 18%. The reason the China number looks lower than the US number is mainly because of an unusual result in the M&A data. If you were to leave that out, they're more or less similar. So there's a substantial separation across trade, capital, and information flows between the US and China, unsurprisingly, since tensions have escalated. Now let's look beyond the US and China. For a broader view of geopolitical shifts, I'd like to show you the shifting composition of global trade, considering not only the US and China, but also groups of countries that are close allies of those countries, as well as the rest of the world. To do that, I'll use a classification of close allies that was developed by Capital Economics. The US Close Allies group includes European economies along with Western-aligned countries in other parts of the world, such as Canada, Australia, and Japan. China's close allies include Russia, Pakistan, Iran, and a variety of smaller economies, mainly in Asia and Africa. And in the interactive tracker online, you can also choose other classifications. So I think the capital economics one is good, but we also have classifications from the IMF, the WTO, if you want to stress test the results yourself online. Using these classifications, let's look at the composition of all trade around the world. Since this includes all trade, the numbers will add up to 100%. The purple at the bottom of the slide is the share of all trade that happens directly between the US and China. That fell from 3.5% of world trade in 2016 all the way down to 2.2% over the first half of 2025. So that's a big decline for the US-China trade lane, but in global perspective, it's actually only a little bit more than 1% of world trade. Here, the yellow is the share of world trade that happens between the rival blocks of close allies. That's down from 12.5% to 10.2%. The share of trade happening between rival blocs of allies started to go down after Russia's full-scale invasion of Ukraine. Trade with Russia was a big factor there. It dropped in 2022, 2023. It actually stabilized in 2024, but then we start to see another small decline so far in the first half of 2025. Again, the magnitude isn't that big. It's about 2% of global trade. So what I've put on the chart so far here at the bottom is all of the trade that's especially susceptible to geopolitical tensions, the trade that happens between geopolitical rivals. Now let's look at the opposite. At the top of the chart, we put the parts of world trade that are between the countries that have the most friendly relationships. So this is trade between allies. And what you can see here is that far more trade happens between allies than with rivals. So there's already a tendency to trade mainly among friendly countries. And it's a pretty stable part of world trade. So I think this is interesting in the context of the discussions about friendshoring. If we were really seeing a lot of friendshoring, we would see more trade happening with allies. The level with allies is stable. Instead, we see less trade with rivals. So it's a bit more of a de-risking pattern than a friendshoring pattern, so to speak. The middle block is what's left. And that's trade with countries that are unaligned geopolitically or that have kind of flexible alignments and can move back and forth. And that's grown from 42% to 47%. So we're seeing less of the trade with rivals, more with these countries that have more intermediate geopolitical positions. And one of the reasons that we don't see bigger geopolitically driven shifts in global flows is that, as the previous chart indicated for trade, most international business activity already happens among friendly countries. For trade, there's 3 times more trade that happens among allies than with geopolitical rivals. For business investment, that's even more concentrated among groups of allies. Last year, there was 9 times more greenfield foreign direct investment projects among allies than with rivals. And for mergers and acquisitions, there were 20 times more of those transactions among allies than with geopolitical rivals. So, on how geopolitical tensions are affecting patterns of international activity, there clearly are some shifts, but they're most apparent between countries with especially acute tensions, such as the US and China. For the world as a whole, geopolitically driven shifts are still quite small. Pardon me. Before moving on, I'd like to show you how you can customize some of the geopolitical trends in the tracker. So if we scroll down past trade growth into the geopolitical section, you can see here the chart I just showed about the US and China separation. You can see an even bigger separation between the EU and Russia. You can customize the shares of world trade. But I'd like to actually draw your attention to a different chart that I think many of you will find useful. Here, this is the chart that I used to show the declining share of US imports that comes from China. One of the new features that we added in this edition of the tracker is the ability to go beyond just annual trends to actually look at this on a monthly basis. That allows us to zoom in and see what's happened month by month. I'll start the chart here in 2024. One of the interesting results is that the share of US trade with China actually started to go down even before the tariffs came into place. After President Trump was elected, companies were already starting to reorient their trade. You can also see, for example, an increase in the last few months in the share of US imports that come from Vietnam. Another piece that's been in the news has been relations between Canada and the United States. When we look at the monthly data, you can see if you choose Canada's imports from the US, you can see a bit of a dip, not that big, but a bit of a dip as tensions rose in the share of Canada's imports coming from the US. So this chart, you can do it annually, can do it monthly, you can choose any countries, and you can also go beyond just imports and exports. You can look at FDI, even scientific research collaboration. So I hope you'll find that useful if you want to drill into the ties between specific pairs of countries. I'd also like to highlight for you another chart here where you can actually make a summary profile of the geopolitical alignments of any country that's of interest to you. So what this does is it takes many different kinds of activity, compares 2 years, and shows you for a given country how much of the flows are with China in the bright red, how much is with China's close allies in the darker red, countries that lean toward China, unaligned, lean toward the US close allies in light blue, and the US in dark blue. So for any country, if you want to see how its flows are aligned geopolitically, this can be useful. We have as a sample here Korea, and what it shows us is that since 2015, there's been a shift in most areas, a declining share of Korea's flows being with China. That follows after the THAAD crisis in relations that happened around 2016. There's an increasing share of flows with the US and its allies, but I also think it's interesting for Korea, and this is a pattern that's true for many other countries. There are larger flows with US allies than with the US itself. So it's always, I think, when you're looking at that Western bloc, it's important not to necessarily focus as much necessarily always on the United States itself, but to look at what's happening in the rest of it. So a little bit of a sample of some more of the customization you can do in the tracker. Time then to move on, I think, to our final topic of the presentation, whether international flows are becoming more regional. There's been a lot of interest recently in nearshoring and the possibility of producing goods closer to customers, which could lead to more regionalized trade patterns. In recent years, however, we actually see the opposite pattern in the global trade data. The share of trade happening within roughly continent-sized regions, that's what the graph on the slide shows right now, has actually been declining in recent years. So less of the world's trade is happening inside regions. That fell to a new low in the first half of 2025 of 50.7%. And because this measure, share of trade within regions, depends a lot on how many regions you use, where you draw the boundaries, we also measure the average distance in kilometers traveled by all trade. Doesn't involve any of those kinds of assumptions. And what we see is that trade is actually happening over longer rather than shorter distances, which is the opposite of what you would see if it was becoming more regional. So over the first half of 2025, trade actually traversed a record high average distance, a record long distance, which was 4,900 kilometers. And I would briefly show you how you can also customize that chart, and it's useful because it gets you to what's happening that's different in different regions. So average distance and regionalization, if you look at global trade, that's what I just presented in the slides. Oh, sorry, we were in Mexico, apologies. That was global trade. And what we see globally is that pattern of longer distance trade. A couple of years ago, I was alerting to the opposite pattern in North America specifically, where you can see the share in gray of North America's trade happening within the region was going up, the average distance was going down, but that pattern actually went into reverse. So we're no longer seeing a regionalization trend in North America. And I did want to show the example of Mexico because I think it's a particularly interesting one. Mexico has a pattern of increasing regionalization in its exports. So you can see Mexico is increasingly exporting to partners in North America, especially the United States, while Mexico's imports are becoming less regional, Mexico bringing in more goods from other parts of the world. So another sense of how you can take the global trend, what's on the slide, check whether you actually see that in the country that's most interesting to you, or if you see something different happening in whatever part of the world you're writing about. This pattern of activity becoming less regional is true not only for trade, that's also what we see for greenfield foreign direct investment. For mergers and acquisitions, there's no clear rising or falling trend for regionalization. So on this question of whether business is becoming more regional, no, there's no general pattern of rising regionalization currently. There are many reasons why business might become more regionalized in the future, but that has not really happened so far. With that, I will conclude. My bottom line take across all the data that I've shown you and the different questions that we discussed is that despite policy headwinds, globalization, when it comes to actual international flows, has not gone into reverse. What we're seeing is a pattern of companies and countries managing the risks of a more turbulent world rather than retreating from international engagement. Thank you, and I look forward to our conversation about this.
Thank you, Professor Altman. I think this tool is fantastic for journalists, especially, and I can tell you from my personal perspective, I am in Washington, D.C. I am following closely every single change coming from the Trump administration in regards of tariffs and trade policy. And this is fantastic to explain some of the stories we see every day when we talk to the people outside and they are saying, oh, I am taking longer to get my goods coming from Mexico, in my case, because I'm Mexican, or the stuff that I bought on social media or on internet is taking longer to get to the US and it's coming from China. So that is really interesting. And again, as an example, in my case, I use a lot of the information coming from Mexico to try to understand how it is affecting North America, for just to say an example. So I would like to ask you something about that because why did you explain the trade growth in North America is growing if the tariffs have impacted the biggest trade partner to the US, which is Mexico, and the USMCA, which is the trade that regulates North America, Mexico, US, and Canada trade?
Sure. So if we look at what we've seen already so far, the trade growth was very strong due to that front-loading wave. But if we look further into the future, North America was the region that had the biggest downgrade to its trade growth forecast. And that reflects the fact that this is the region where we're actually having the tariff increases originating in the United States. So it was, I would say, a temporary lift to North America because of the rush to get goods in advance of tariff increases. If we look forward, North America is the region that has the largest reduction in trade growth because of this.
Professor, if I'm not wrong, what I saw in the wave of forecasts, I saw that the forecast lows for the following years, but the
Mhm.
tariffs keep increasing, or at least they will remain for the entire Trump administration, or at least we haven't seen another indicator of they will disappear. Eh, so if they will remain, why is that we are seeing that the trade growth seems to either continues in the same level or growing?
Yeah, so what we're seeing in the forecast is, and the way it was recently updated, it reflects that initially what happened was we were expecting a big hit to trade growth in 2025. Then, because of the front loading and the growth in China's exports, that really didn't happen. So it's just a small reduction for 2025, and then a much bigger reduction to the forecast for 2026. And that reflects essentially the way the tariff announcements come in very fast and there are high numbers, but the actual implementation of the tariffs has been much slower. So you've had a much more gradual increase in the actual tariffs that are charged. And that's led to the fact that, and what that seems to be leading to is a delayed effect. So you had front loading, which which um, which countered some of the early effects, and then you have this slow ramp up of the tariffs, which pushes some of the harm to trade growth from 2025 to 2026. Then, if we look further into 2027 and so on, the expectation is that you've already taken this hit, it affects the baseline, and then you start to see more of a normalization of the growth trend 27, 28 into 29.
And before we go to the questions that we are getting in our Q&A box, Professor, I want to ask you, countries are diversifying, right? When it comes about trading, do you forecast, according to the data, a faster change in international trade with China specifically? Because I think that's the biggest actor in the most recent changes we've seen, at least from the trade policies coming from Washington.
Yes, China is really a place where things are changing very, very fast. So I mentioned that you had the sharp decline in China's exports to the US, offset by big increases to ASEAN, to Africa, to Europe. It's a lot of change going very quickly for China. And what China does affects the world quite a lot because China is the biggest participant in global trade. You mentioned diversification, and I think that's actually an interesting and a bit untold piece of the China story. Over the past decade, China has been substantially diversifying its export markets. So if you take, there's a chart in the tracker which I could pull up if you want to see it. Otherwise, I'll just summarize here. There's a chart in the tracker on diversification. China has been diversifying its trade. One of the facts is that over the past decade, the share of China's trade that is with China's top five trade partners, or so with, outside of China's top five trade partners. So has gone let's put it the simpler way, sorry. The share of China's trade that's with their top 5 trade partners has gone down by 10 percentage points. So they substantially diversified their trade over that period. And I haven't seen a similar change for any other country. And I think that actually helped set China up for sustaining their trade growth during this period because they had already been diversifying for a time, and that would set them up to then be able to grow those ties that they'd been building in other parts of the world. China certainly, and there's a lot of other data on China in the tracker.
That's very interesting. And we have a question from Momo from Nikkei for the professor, for Mr. Professor Altman. In your view, what is the single biggest misconception about globalization today that the tracker is trying to correct?
So the biggest misconception I would say today is that we are in a period of deglobalization. There's a lot of talk about globalization having gone into reverse. And when we look at it, what I think is that this talk of globalization going into reverse is really driven by policy rather than actual patterns of business activity. But if we think of, what is globalization really? It's not treaties and ties of what governments are negotiating and the tenor of the discourse between governments. Globalization is really how interdependent our countries, how connected our countries in actual flows of trade, capital, information, and people. How much are we actually interacting across borders, and with whom are we interacting? And those actual patterns of interaction are much more stable in most cases than the politics. And so I think the biggest misconception I'd like to address here is that there's a lot of talk of deglobalization, but my take is that deglobalization is actually really still a risk rather than a reality because the interactions that are happening between countries continue to move along in the face of this pattern in politics.
So do you think a better word would be reshaping?
We're seeing changes in patterns of activity more than declines in actual levels of activity, indeed.
Okay, and then we have here, Professor, another question from Ida from Business Insider. According to the tracker, large deals are sustaining investment levels, even as the count of cross-border transactions declines. Does this raise concerns about concentration or about smaller firms' access to cross-border opportunities?
Thank you, and thanks for having read the tracker so carefully to pick up on those kinds of details. So, indeed, as we're looking at the investment trends, we went back and forth, really trying to think, how should we characterize this pattern? Because the amount, in terms of, let's say, the amount of dollars that are being invested by businesses across borders has been pretty stable, whereas we've seen declines in the first and second quarter. Especially from Q1 to Q2, to be precise about it, in the number of transactions, both in terms of greenfield foreign direct investment, so companies setting up plants or other operations abroad, as well as mergers and acquisitions transactions. And so we wanted to be really careful about how we characterize that because it shows that the investment is still flowing, but there's something concerning in the fact that the number of transactions has gone down. I want to be careful to not overplay it because investment flows are really volatile. Even for kind of in a normal times, it can go up some quarters, go down for 2 quarters. So I wouldn't read too much into 2 quarters of trends on a capital flow measure. But my take on it was that it is probably reflective of the uncertainty that's in the environment because research tells us that smaller companies tend to pull back their investment more than larger companies do in times of heightened uncertainty. And it's a natural thing if you're running a business, when you're not sure what the policy environment is going to be, you don't want to make an investment commitment that you might regret. And so my take is that it probably is reflective of the uncertainty in the environment, but to be very clear and candid about it, it's a couple of data points on the number of transactions. And it's probably too soon to really draw a very, very firm conclusion from it, something to keep monitoring.
Professor, the data suggests no broad shift from foreign to domestic investment. How do you reconcile that with the growing narrative of, how do you reconcile that with the growing narrative of economic nationalism?
Here, I think it is a big difference between, let's say, a narrative and the politics surrounding a narrative and actual business decisions aggregated up from a lot of firms that are trying to do what's best for their businesses and looking at the opportunities that they face. So certainly there's a lot of talk of economic nationalism and there are policy changes, but there are vast numbers of companies all around the world trying to find the best opportunities. And some of them say, okay, well, we found this is an opportunity at home we need to invest in. This is an opportunity abroad that we need to invest in. And when we aggregate all of that, we find that the balance hasn't really changed. And sometimes, so there are also big investments where geopolitics leads to big cross-border investments rather than deterring them. So, for example, Taiwan Semiconductor with their big expansion in the U.S. That's one of the biggest foreign direct investment projects that we've seen recently. So it is ultimately, I think, the difference between political discourse and narrative versus what we can aggregate up from the business statistics.
Professor, we have another question here in the box. Christian Presa. He's from Mundo Logística in Brazil. Here is the question. The report suggests that countries not strongly aligned with major powers like Brazil might benefit from shifts in global trade patterns as the US and China reduce direct exchanges. From your perspective, does the data confirm that Brazil and other countries are able to strengthen their global connectedness?
Yes. So this is the pattern that we've seen so far. We don't have the ability to make predictions how it's going to go in the future. It's a real debate whether these kind of intermediate alignments are going to be viable moving forward, or if the politics is going to force countries that really don't want to choose a side one way or the other. But the pattern that we've seen so far is indeed what the questioner has asked about, that the countries that have this more flexible intermediate position have been growing their share of global trade and benefiting from realignments. So Brazil is an example. Others that are, I think, quite strong examples would be Vietnam, United Arab Emirates, and there are several others. So that is the pattern that we see today, and I think that's the pattern that leaders in many countries want to see continue, and it's something that we're going to have to watch whether or not that ultimately continues to work or not.
Many questions, Professor. Here, Mike, from the Australian. Looking ahead, what indicators or early signals will you be watching to confirm whether deglobalization is beginning in earnest?
Sure. So here, what I would look for is whether you start to see, in the data, kind of really sharp declines and sustained declines in many of the indicators, and whether it's spreading globally. So if you take the example that I showed you of the U.S. Share of imports coming from China, there you saw a real sharp declining trend. There's a much bigger one that I could have shown you, which is between Russia and Western aligned countries. There it was a really stark break after the start of the full-scale invasion of Ukraine. But those are still quite limited examples among countries that have real acute tensions between them. If that were to spread globally and we start to see those kinds of trends in many parts of the world, that would be a signal that deglobalization is happening. Also, when we look at those kinds of measures of international relative to domestic activity, so for example, that measure of what share of the mergers and acquisitions are happening across borders versus domestically. If that goes sharply down and it stays down, that would be an indication of deglobalization in business. That's all data driven. I'd like to also just give you a bit of a most of my work is all about data, but I'd also give you a non-data driven answer that you might find perhaps interesting. Because we think of globalization as having a lot to do with interdependence. How much do developments in one part of the world affect developments in other parts of the world? And because globalization continues to be quite substantial, we're very keenly watching what is happening in other parts of the world for how it might affect us. If there was a really substantial deglobalization shift that happened, you might actually be less likely to ask me that question because you wouldn't be as worried about what's happening in other parts of the world. So one kind of more qualitative indicator of deglobalization would be that we feel that there is sufficiently less interdependence among countries that it actually matters less what's happening. So far, deglobalization hasn't happened. It doesn't show up really in the charts, and it doesn't show up in the extent to which we care about developments in other countries because we think they might affect us.
Do you think, Professor, that the geopolitical rivalry might fracture the economy or the growth, the trade growth?
So I think that kind of the small changes that we're seeing along those lines are certainly likely to continue. But I actually think that a really stark break between these blocks is unlikely. First, let me also comment. We were talking, the last question was about deglobalization. Geopolitical rivalry does pose threats because it creates the risk of interdependence being weaponized to harm another country's interest. And so it raises these questions about, do we need to make changes to protect against that? But the main reasons why I think that a really profound split is not that likely are the kinds of things that I showed you before about how most of the activity is already among friendly countries, how there's a big part of the world that has kind of intermediate alignments and really strong incentives to maintain ties and to continue to benefit from interactions with different groups. There are a lot of reasons why a really sharp break between geopolitical rivals would be quite harmful economically. The IMF has made estimates saying that if all trade was to stop between these different geopolitical blocs, you could see a decline in world GDP that exceeds 7%. There are really strong incentives for people to prevent that from happening. And so at the moment, I think it's not that likely. Another reason that is well, actually, maybe I'll just stop there. I think it's not a very likely scenario, but I think this kind of intermediate weakening of ties is more likely than a complete separation.
And now from Argentina, Professor, what's your perspective? And what is your perspective? And do you see an opportunity for the country's foreign trade as China and the US maintain these policies? In your view, what kind of global context is most favorable for developing economies?
So in this report, we didn't do any analysis specifically about Argentina, so I can't comment on that particular case. But I would comment that globally, in terms of what is best for economic development, it would be being able to maintain ties with partners around the world and to grow them. We do see a positive correlation between participation in trade, for example, and faster economic growth. So countries that engage more with trade tend to grow faster. And in fact, there's recent research over the past, let's say, decade and a half that has actually gotten to show that this is really a causal contribution. So we're always worried about saying, well, the countries that are more engaged in trade grow faster, but is it just coincidence? It's not. There is clear evidence that tells you that engaging more with globalization and trade actually can help accelerate growth. I could comment a little bit on what are some of the key factors that help countries to engage more on that if it's of interest. But I would say being able to maintain ties with your optimal trade partners across geopolitical blocks is beneficial.
Professor, given that most businesses still happen among friendly countries, are we overestimating the risk of a full-scale economic decoupling?
My take is that it's not a very likely scenario, but it is something that we need to, I mentioned managing risks. In business, the prudent thing is you need to understand the risks that are out there and you need to manage them prudently. So I think it's important, for example, for companies to stress test the ties that they have with countries that might be especially vulnerable, keeping in mind that a complete break is not that likely a scenario. But that there are risks that the prudent manager has to understand and think through how they would manage. So stress testing against those kinds of risks is certainly prudent.
We've talked a little bit about China, but China managed to offset lower exports to the US by increasing sales elsewhere. What regions are absorbing that redirected trade?
Sure. So the biggest destination of that redirected trade is in Southeast Asia. So if you're looking at the countries in the ASEAN region, that's where the biggest amount has gone. After that would come Africa and Europe. And it's a big amount of trade that has shifted to those places, and so I think it's going to be something really important to watch whether that can be sustained or whether this is a phenomenon that may run its course and would not be sustained. And you have questions both of how much of an export increase can these markets absorb? Some of them are smaller, and so you have a question about how much can that demand actually absorb? And then you have policy questions. So far, we haven't seen that much of countries outside of the United States raising trade barriers in response, but it's something to watch out for because if you see surges of imports coming in, there may be pressure in different countries to protect domestic industries. So something that we need to watch to make sure we are on top of that.
Professor from Katharina from, I hope I pronounce this correctly, Handelsblad. How do current U.S. trade and industrial policies, particularly new tariffs, affect the transatlantic trade balance? And what does your data show about European firms' adaptation strategies?
So we haven't done any analysis, and thank you for the question. We haven't done any analysis on the transatlantic trade balance here, so I can't really speak to that yet. In terms of European firms' adaptation strategies, I think we're still in early stages, and I know some European companies are talking about making investments in response to tariffs, but we also don't have analysis to quantify that. I think one piece that's of interest, perhaps, is that trade flows have adjusted very, very quickly. If we look at which are over the first half of 2025, the trade lanes where we saw the most growth, several of them involved Europe to US. Ireland to United States was near the top. Might have been the top. I'd have to check. It's in the tracker. Ireland to United States, Switzerland to United States, and the biggest factor was front loading of pharmaceutical imports. So here you have examples of where companies doing business between Europe and the US, they saw what was happening and they moved very quickly to try to protect themselves. Thank you for the question, and I regret that we didn't have more data to answer it, but we'll keep monitoring these topics going forward.
Professor, and I want to go back to your previous answer and ask you, are smaller economies in Asia or Africa becoming more active players in filling the trade gaps left by the US-China tensions? And what's the opportunity for other smaller economies to fill those gaps?
So we certainly are seeing shifts where other economies are filling gaps where let's say we talked before about declining imports coming from China to the US, other economies filling those gaps. I would say rather than largely, if we look at the biggest patterns in the data, rather than it largely being smaller economies in Asia or Africa, I would say it's medium to big economies that are doing the bulk of it, that are either close to China or close to the US. So we see countries close to China, such as Vietnam, filling in much more, pulling in components from China, assembling, doing more work there, sending products to the US. ASEAN as a region in Southeast Asia being a place that grows its share in response to this. And then Mexico in North America also doing such a trend. So you see kind of the medium to bigger economies, particularly closer to either China or the US, filling more of it. Another one that I should have mentioned is also India. India is big enough to make quite a difference. And you see, for example, the shift of iPhone production serving the US market from China to India and growing trade ties there. Of course, the tariffs and the politics between India and US, like some other examples, Brazil, we had a question from there before, raised some questions about where that goes going forward. But countries like India have so far played quite a big role in that and have the potential to do quite a bit more going forward, especially given India's size, for example.
If you can mention one or maybe more, what's the single most striking shift you observed in global trade patterns after President Trump's return to the office?
Mm-hmm. So most striking shift, I think what I would say, actually, you said after he returned to office, I think one of the things that's most striking in the data is how trade volumes and trade patterns started changing even before. If you look at the trade volume growth, it started to move upward almost immediately after his election. Before he came into office, before the tariffs started, people started front loading, people started making changes. And it speaks to the agility of business and how fast they respond to some of these developments. So trade volumes started to go up. And then immediately, as I showed in that slide about China, the share with China started to decline. Others started to pick up. So early on, you had that pharmaceuticals trade. So Ireland, Switzerland jumped in the rankings, then came back down. Then you had Vietnam coming up in the rankings. So I would say it's how fast things moved, probably more so than the specific changes that I found surprising.
Professor, and the policies that Trump is putting in place are not new. We saw them in the first term as well, in a different way, with a different narrative or political words, if we can say it that way. But they were there. Maybe they were less aggressive than what we are seeing right now, but they were there. So do you think that we learned something from that first term that probably the countries now are getting ready or reacting ahead of potential and more aggressive indicators?
Yes, I think there was learning on the part of governments and learning on the part of managers and firms. And it's learning that came from the trade conflicts in the first Trump administration. It's learning that continued as we still had some developments during the Biden administration. Also, the COVID-19 pandemic stress test supply chains and got managers and governments looking at where are the risks and how can they be mitigated. And I think some of that preparation and some of what firms have done in boosting supply chain visibility, boosting supply chain flexibility, has helped them to actually weather these shocks better than they otherwise could. I think there's been, quite a lot of learning that took place over this period through a variety of stresses, both political as well as the pandemic being the other really big one.
I really need to go deep in the tracker, but according to the slides that you showed to us, it seems like the forecast and the overall picture is very optimistic, even though we are facing challenges. It seems very optimistic for the next 10 years.
Sure. So you perhaps you want me to speak to why can trade continue growing despite the fact that we have U.S. tariffs rising to levels we haven't seen since the 1920s. I would point to two main reasons why global trade can keep growing. I mean, yes, we had a downgrade, a reduction in the growth forecast, but the two main reasons why it can continue growing are one, the vast majority of trade doesn't involve the United States. So its U.S. share of imports last year was 13%, U.S. share of exports was 9%. Those are big enough numbers to matter. The U.S. makes a difference for the world, but most trade is not with the U.S. And there are other parts of the world that are growing faster than the U.S. and where there's a lot of growth. And so it's possible for countries to redirect exactly as China has done to other markets. The other example, or the other key factor, is that we're not seeing a pattern of other countries following the U.S. down the path of across-the-board tariff increases. To the contrary, what we've been seeing is actually other countries redoubling their efforts to negotiate trade agreements and to secure their access to other markets. And so that also pushes back against this concern that we would have a big reduction in trade, because if most other countries are continuing to stay open to trade. And actually, there's a third factor I probably should have mentioned before, which is that retaliation against US tariffs was less than anticipated. So before the increases in US tariffs, like I think many other people, expected that US will raise the tariffs, for example, on European Union, many other economies, and you'd see a kind of parallel tit for tat increasing of tariffs. And actually, instead, we've not seen as much retaliation, which is another factor that contributed to the expectations of trade growth continuing.
Professor, I definitely think that this tool would be very useful for many of us reporters reporting daily what is going on, and we need to put a face and also a story and numbers behind every single policy coming from the US, from Washington, and shaping the rest of the global trade. So I really appreciate your information, your presentation today, Professor. It's very useful.
Thank you very much, and thank you for the opportunity, and thank you to everyone in the audience for your interest. Appreciate it.
Thank you, Professor Stephen Altman, Senior Research Scholar and Research Assistant Professor at NYU Stern School of Business and Director of the DHL Initiative on globalization. Just as a reminder, this educational program is developed in partnership with DHL and NYU, and Mr. Stephen A. Altman, research assistant professor in the Department of Management and Organizations at the New York University Stern School of Business, the Association of Foreign Press Correspondents in the US, is solely responsible for the development and content of this program. Thank you so much.